If you're looking at Alberta in 2026 and thinking this feels slower than it did a couple years ago, you're right. And that slowdown is exactly why CMHC still works here, when it doesn't in most other markets. In this video, I want to show you why normalization is actually healthy, why CMHC works best in balanced markets, not overheated ones, and why Alberta remains the most viable place in Canada to use CMHC MLI Select properly in 2026. If you're new here, welcome. And if you've been following along, I appreciate you being here. Most investors watching this aren't chasing the next boom. You're trying to invest in markets that still work after the excitement fades. That's what this conversation is really about. Let's be clear about what's happening on the ground. Compared to the last few years, Alberta has seen vacancy edge up slightly, rent growth flatten at the top end, incentives return in some submarkets. That sounds negative, but only if you assume the 2021 to 2023 environment was normal. It wasn't. That period was driven by extreme migration, tight supply, and rapid rent increases. What we're seeing now is a reset, not a reversal. The biggest change in 2026 is this: easy wins are gone. You can't assume rent growth, you can't rely on appreciation, and you can't ignore operations anymore. Returns now come from tenant retention, expense control, proper unit mix, and professional management. In other words, from actually running the asset well. That's not bad news. That's where experienced investors gain an edge. This is where CMHC gets misunderstood. CMHC is not an appreciation program. It's not a hype-driven program. CMHC approves cash flow, realistic rents, survivable expenses. CMHC does not approve optimism, aggressive assumptions, or it'll work later stories. In normalized markets, this distinction matters more than ever. Most Canadian markets fail CMHC math at high leverage. Prices are too high, margins are too thin, and debt service becomes fragile at 90 to 95% loan to value. Alberta is different. Even after normalization, Alberta still offers lower entry prices, rents that support debt service, no rent control, and a landlord-friendly operating environment. That's why 5 to 10% down CMHC structures are still achievable here and increasingly rare elsewhere. So Alberta didn't break, it matured. And normalization didn't kill CMHC, it made market selection and deal quality matter more than ever. If you're investing under CMHC in 2026, the payoff is simple. Choose markets where the math still works today, not where you're hoping it will later. And if this way of thinking resonates, if you want to make sure both the market and the deal pass real underwriting, there's a link below where you can learn more about how I work with investors and whether it makes sense to have a direct conversation. No pressure, just clarity before capital gets committed. See you next week.